Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, Zane, welcome back. We're here on March 21st, 9:15 Central. How's it going up in Montana this week?
Fantastic. Spring is here.
Yeah, things are warming up.
To the calendar.
Spring the equinox.
And in some archaic studies of the world, it's actually New Year. Happy New Year, Alex.
That's pretty interesting. Very cool. Yeah, as I say, this is the day that all the pyramids and other features in South America, too, are lining up with the solar system. So, I don't know, something going on. But returning to the podcast, this week, got a few topics. Last week we talked a little bit about EU, Russia, some evolving questions about Russian pipeline gas, talked about some Mother Nature demand impacts. I think this week we talked a little bit about what OPEC was going to do. So maybe we can kick it off there and do a little discussion of what numbers came out last week and then the updated compensations from this week.
So back on March 3rd, it was announced that OPEC would move forward with its plans to begin bringing barrels back on a very ratable schedule over 2 years to essentially fully instate the curtailed 2 million barrels or so. Let's call it 2.2. In that same release, it was stated that those overproducing nations that have been overproducing really since I can't even remember at this point if it was the second or the third tranche of voluntary cuts, would make up for their overproduction primarily in 2024. It was promised by March 17th. So I don't know, we'll call it on time, just a few days late. And maybe they did send it in by the 17th and OPEC took till the 20th to publish it. So on Thursday, March 20th, there was a table released, which can be found out on the good old OPEC website, or maybe you even put it in the show notes. And most of the member nations, meaning all but one, has some form of makeup to be done, beginning, interestingly, in March, which is now over. So that's going to be, I guess, the first round of fun will be once the March production numbers are released, call it first day of April or so. From what baseline did these makeup barrels get made up? Meaning from where we were producing or from where they were supposed to be producing? Because I think the table that was published yesterday leaves a lot to the imagination. Iraq, for instance, is, about 120,000 barrels a day each month through June 26 is what they're supposed to lower their output. But there were many months in there where they had been producing a couple 100,000 barrels a day over what they were supposed to. Right. So I don't know that there's a great deal of clarity. I mean, it's nice to see, a promise made, promise kept, here's the plan. But a plan is only good insofar as those
follow through,
carrying out the plan, or actually delivering.
Yeah.
At peak, so just, I guess, while we're verbally covering some of the graphics that can be published later, for instance, August 2025, so here in a few months, near the middle of Q3, there's supposed to be 414,000 barrels a day less coming from OPEC. But again, from what benchmark? I think that's still what's got the crude market in a state of paralysis. Yeah. We're the better part of a couple weeks now of just hanging very closely to $67 a barrel. On an internal call this week, one of the quips that I personally made was, you probably have enough change in your pocket to count how far from $67 we have been, and maybe will be for the foreseeable future until we see what OPEC does. Laughably, not that anybody actually has change in their pocket anymore.
Yeah, I think as we highlighted last week, total OPEC DOC production, so OPEC plus, was 363,000 barrels per day higher than intended. And core OPEC, I believe it was about just over 150,000 barrels per day. And that was contributed by, I think, 9 of the core OPEC members. So it definitely wasn't just 1 or 2 overproducing. So it'll be interesting to see how that pans out.
One of the most interesting ones to me that, when listeners have a moment, and maybe they already have, going out and taking a look at this makeup schedule, one of the ones that really stands out is the UAE. Quietly, they didn't seem to get much attention at all in terms of being one of the overproducers. And lo and behold, their makeup schedule is one of the lightest. It never gets above 55,000 barrels a day in any month in this makeup period, March 25 through June 26. I don't know what the UAE has on OPEC, but they certainly get to play by their own rules.
Yeah, they've been hungry to get some production online. I think they have some new projects that are going to add another 250,000 barrels per day that they've just had to kind of punt to a later date. So I think that they're starting to push pretty hard for that.
Staying on UAE, and I want to stick with them for a minute and kind of this who's doing what, where in the world. There was another interesting update this week regarding Chevron and the license in Venezuela. It's been proposed that the conclusion of that temporary license is now going to be extended, which is also maybe a theme we can stick on a little bit today. So, Kazakhstan, where Chevron is also a key operator in the Tengiz field, has been really the location in Kazakhstan that's driven their overproduction. So maybe Kazakhstan's production does go down, but maybe the 350,000 barrels a day or so that the market thought it was going to lose from Venezuela is still online rather indefinitely. Right. Feels like a game of 3-card Monte. I feel like I'm on a New York street corner and somebody's got a trench coat full of watches that I'm playing for.
Exactly. Just shifting here and there. And that's the other, the point that you made on the OPEC baseline is really interesting to go back and look at those numbers on each MOMER release, how the same month shifts over time and seems to, just kind of steadily fit the narrative that they're trying to shape. So it'd be interesting to go back and plot that for people to see, because, it's sometimes pretty substantial. There's a couple of months in there on the supply side that were a few 100,000 barrels per day different for the same month by MOMER. So it'd be interesting to watch that one. Good point on the Venezuela side. On that front, related to that, the tariffs for the American crude producers have some other updates as well. So tariff commentary for Canada and Mexico got delayed again to April 2nd. But behind the scenes, I think one of the really interesting, just subtle pieces of commentary from the Trump administration was the emerging push for likely exemptions or exceptions for energy imports from Canada and Mexico, as long as they're USMCA compliant. So the rules of origin for the USMCA basically states that goods produced in that country, so in Mexico or in Canada, are exempt from the tariffs. So free trade between the US, Canada, and Mexico for goods produced in those countries, which, as we talked about earlier this week, that definitely applies to, Canadian crude, electricity, and all the energy that I think people were pretty afraid would impact, say, the Midwest refiners in particular. So I don't know if you have any additional thoughts.
Well, I'm going to just start with taking a personal walk of shame, or I guess I'll just say talk of shame, since I'm not actually walking anywhere. But I never even really thought to go out and look at the USMCA, as, myself and I would say most in the market were sharing their ideas, opinions on what these tariffs would do in terms of the flow of barrels or megawatts or MMBTUs. I mean, it's been out there all along, and I'm sure some were talking about it. So kudos to you. I'm sorry nobody was listening, or at least I'm sorry I wasn't. It's been out there in black and white for a long time.
I think it's still not that clear. You never really know with the Trump administration, but I think that it's emerging
Hey, look, you're right back to talking about pencil whip in the past. You can go back. No, what I actually said was, take the eraser off your pencil. I'm tired of trying to figure out what exactly it was that you said. You know, I think like many things in the crude market, specifically state of paralysis. Well, what do we do? It's, you know, it was going to change on April 2nd. Well, no, now we're going to delay that. Or even if the USMCA does change, that piece of it's not going to change. You know, it feels like a forever waiting game on what's going to come next. It's like, you know, kids have the bags packed, they're ready for summer vacation, and then you're just waiting for the next concrete change. I'm not exactly sure where we go there.
One of the interesting tangents on the Canada crude side, at least, and for Mexico, was the weekly imports, which, you know, I think the weekly numbers should be taken with a grain of salt. They are pretty volatile relative to the monthly numbers. But interestingly, the U.S. imports from Canada last week dropped pretty substantially, 541,000 barrels per day. So bringing a 2-week change in those to about 960,000 barrels per day. So went from fairly high in the seasonal range to the low end of the seasonal range. Would be the lowest weekly import since March 2023. And Mexico was pretty similar, dropped to, I believe it was 195,000 barrels per day last week, 195,000. And that would be the 5th lowest ever for the weekly values. So whether the USMCA exceptions for rules of origin were understood by many, I don't know. Or if it's kind of like many goods responding to tariffs, just kind of a preemptive increase in costs to, I guess, mitigate the immediate impacts. And that's having some effect on, say, PADD 2's crude demand from Canada. The other part that I think is interesting to look at for Canada and the Midwest is the stocks of refined products. So both total gasoline stocks and distillate stocks in PADD 2 are meaningfully above the 5-year seasonal range. And in the case of total gasoline, a couple 100,000 barrels per day higher than the 5-year seasonal high. So definitely have some buffer capacity in there. I don't know if you have any thoughts on the product inventory side. And
I mean, I think what you just laid out actually should be given credit for the reason why imports have fallen. And then the other point you made earlier about the volatility in the weekly data, you know, I don't know, just logically thinking there, if I've got plenty of the refined stuff laying around, and if there's any uncertainty at all, how about I slow the, you know, processing machine here for a little bit, see how it all plays out, and, you know, go from there. You know, I think the other interesting thing, just we might have even brought it up last week, so apologize if this is redundant. You know, the Canadian diffs have markedly improved. You know, the original proposal by most in the market, and this, I guess, would be the opposite of the walk of the shame. I mean, give myself a walking pat on the back here. You know, the idea that Canadian diffs were going to get destroyed because the Canadian producer was going to have to eat the impact of these tariffs. Wrong. So here we are, and Canadian diffs have materially improved across the board. So, you know, I think what you just outlined with the products on hand is really the key factor.
Yeah. Don't have to buy if you don't need it. If you don't need it. So, yeah. Sticking with some of this weekly EIA data that I think is pretty interesting from the demand perspective. So I think maybe some brief commentary on the broader economic indicators after this, but just from the crude demand landscape, it seems like the demand uncertainty is still prevalent as it has been for, you know, most of 2024 as well, with China kind of shifting its role as the global demand growth driver. But inside the U.S., you know, I think there is a little bit of this underlying bearish sentiment about U.S. product demand. But when you look at, products supplied for finished motor gasoline, right at the 5-year seasonal average, you look at total petroleum products, the 4-week average is above the 5-year seasonal average, and kind of continue down the list. And, distillates have been above the 5-year seasonal average for most of 2025 so far this year. So,
I want to say that if you asked 100 people in broader economic markets if there would be a recession anytime soon, at any point over the last now almost 2.5 years. I mean, we've been forecasting a recession now since 2023. And it's kind of hard to find anywhere in the world that's sending this clear signal. On previous podcasts, you've shared plenty of the economic woes of Europe. But is that new? Wasn't it like 2017 when Greece was literally just going to disappear and it was just going to be this beautiful, empty land with amazingly clear blue water? No one could, actually afford to, live there anymore. So the European woes are not anything new. And then, like you just pointed out in the U.S., and while it may be shifting, we've covered before, Chinese demand may not actually be on mainland China. There's some other interesting headlines out about the possibility of tariffs on Vietnam, where China has a significant influence. Yeah. If you want to go down that rabbit hole, I think now would be a fine time. But generally speaking, with, equity markets in the U.S. still doing quite well while down about 10% from recent highs, you look at a chart of them and certainly still seems like we're climbing the mountain, not falling down the backside of it.
Yeah, it's pretty interesting on the European point that you made. I think the one difference that I'd point out is that a lot of Europe's economic troubles right now are really focused on Germany. And Germany as the, traditional industrial hub of the European Union and the largest economy of the bloc. I think that that's kind of one just to monitor. They're not a substantial demand growth driver or anything like that, but I think the industrial activity in Germany is struggling pretty badly. I think that their industrial electricity demand is going to be dropping to a new record low this year. And, you've been kind of teetering on this edge of recession for going on a full year. They already had a double dip touch of recession. So maybe some numbers will change and they'll, reverse history as we talked about with OPEC. But, at least for Germany, I think that's definitely a risk. But in the U.S., on the industrial side, I think that picture is not as clear. I think we had a little bit of I think it was a 26-month streak or something long like that, where you had contracting industrial activity in the U.S., according to anecdotal PMIs. But when we look at, the latest industrial production numbers from this week, you had industrial production grow 0.7% month over month, which was 2x expectations. Capacity utilization is climbing back up. You have manufacturing production, which is kind of the subcomponent of industrial production, growing 0.9% month over month. So that's 9 times expectations. So, I think the picture is not nearly as bearish. And I think people have been kind of focused on this Fed commentary as they have been for a lot of 2024 as well. And, when Powell comes out and says the committee has adjusted their inflation expectations higher and their growth expectations lower because of tariffs, I think that that's a little bit of the, maybe political commentary between the Fed and the Trump administration for some historical heated exchanges between the two. But I can't really see that number lining up. I think that maybe they're just baking in their expectations for the effects of tariffs. So they're kind of performing more of a forecasting kind of duty instead of more data driven at this point is my take. So,
yeah, I think I generally agree with you. I guess my, stepping back and looking at this from a distance, it's a little bit unclear if we're, being told what's going to happen before it happens because there is an imminent recession, or if it's just a reshuffling of who gets what from where. Yeah. I mean, logically speaking, if tariffs are implemented to make America great again, then you would make more stuff here. The U.S. steel producing community, while the tariffs haven't gone so far as to impact the finished steel products that are brought in, it's really raw steel. There's the possibility that gets deepened. I'll stay in the energy world. We bring in a great deal of pipe from Korea. A lot of finished product in the way of moving hydrocarbons comes from Korea. And, honestly, for the most part, we haven't had the ability to produce as much pipe as maybe we've needed, in the past decade, scratch the last 4 years where there was an attempted hiatus on all things hydrocarbon related, but it's a pretty clear sign now. We've got special committees developed to make sure that that's a key part of the Making America Great Again. We've got great U.S. steel producers like Nucor Steel that have recently developed a capacity to not make the finished product, but actually produce the as close material as you can get to it. And so I think that's another interesting topic of is there a recession or not? Or is it just a reshuffling of where goods are produced versus where they're consumed?
Yeah. And the short-term disruption of tariffs, shouldn't be ignored necessarily, but I think a lot of these inflation expectations need to do a better job of recognizing the role of energy. And as we've seen, crude coming down, as we just talked about, trading right around 67, natural gas coming off in the last week or so. I think that should be the indicator to watch for inflation. We've talked about this a lot, but energy plays a role in every aspect of economic activity. So food production for your, fertilizers, your transportation of goods and food, and, your general just electricity costs. So I think we're coming into an interesting time too, as, we hit the spring months. Demand is going to be coming off. You have some pretty strong renewable output in the shoulder months. So electricity costs generally are going to be hitting the highest frequency of negative power price hours during these months for most balancing areas in the US. And then, for fuels, I think until we see any material change from, what we talked about with OPEC or, some unknown variable that changes, it's kind of hard to see how inflation would meaningfully go higher without energy driving that.
Concur. And then we've got interesting times right now. We talked earlier about the crude market, how it's just stuck around 67. You've got this interesting dynamic in the domestic gas market where, we've talked before how we've flipped from steep contango to steep backwardation. We're still backwardated. For example, summer 25 is trading about 20 cents over summer 26, 430 and 410 respectively, these 5 minutes. And that would tell you that we don't have enough, that there is a energy driven inflationary environment upon us now. But then when you really start picking it apart and getting in the weeds, just the underlying fundamentals for domestic natural gas don't look so great right now. Yesterday, Thursday, March 20th, we got a 9 BCF injection. That's only the 7th injection we've seen since 2001 for the second week of March. That's not good. And, weather was certainly a key factor, but we weren't in any way seeing historically mild, it wasn't record setting warmth across the U.S. that drove that. Mm-hmm. So, in some ways, the gas market has seen these pretty significant changes, both in curve shape and absolute price, while the crude curve has just slowly slipped down to the level that, chicken and the egg. Did the historical price curve tell people that it must be $65 or so where the U.S. producer can't produce? Or was it the U.S. producer saying that that's the level I can't produce below? And so the price curve went there. I don't know. Good luck detangling that. But in some ways, it feels like we are, with both domestic gas and crude, poised for some meaningful changes in the near term. with oil, do we really need to probe and find out how resilient the U.S. producer is? Meaning, is demand going to once again disappoint? Add a little context to oil demand disappointing. It's disappointed in 23 and 24, but only because expectations were so outlandishly high, which is something we've talked about, on our daily market updates with our clients and weekly materials. And I believe even on this podcast, and demand expectations are rather reasonable right now. 1 million to 1.5 million barrels a day of global demand growth, pretty normal. So the disappointment on the demand side at this point, if it occurs, would actually be something that would likely cause the crude markets to send a price signal that says not right now. And mind you, OPEC in all of their public releases has clearly stated they reserve the right to change their mind. In theory, they could change their mind in the next week about their plans for April, and we could have less supply. For the gas market domestically, I think with the strength in U.S. LNG imports, you've got the Venture Global facilities clicking on all cylinders, particularly the fast ramp for Plaquemines. Just today, we set a new all-time high for U.S. LNG feed gas demand at 16.7 BCF a day. Well, a day for today. We'll see if that sticks. Pipeline data certainly gets revised as final cycles come through, but there's even just for the month ahead, you've got the potential for significant year-over-year strength in LNG feed gas demand, maybe as much as 4 BCF a day. But then you've got production levels, at least as they're reported by all those modeling U.S. dry gas production, that are up the same or more, which interestingly in the domestic market gets back to, I think, an area where I'm going to call you one of the preeminent experts, all the micro nuances in U.S. power markets.
Yeah.
What is power market behavior telling us? And even with you as the expert, a cautionary tale for anyone listening, trying to make sense of what's going on either in power pricing or in the fuel mix in any ISO, and certainly across the nation during the months of April or May. Good luck with that. Annual, demand on an annual basis hits its low in late April, early May. So it creates a massive amount of flexibility in fuel switching. When the amount that has to be served relative to the installed capacity is at its lowest ratio, you could choose what you want. And in the case of renewables are first in line. They get to make the first choice. Yeah. The wind blows, it goes barging through the door and says, me, I'm number one. I cost zero, remember? Not really. I mean, we paid you, windmill, a big old production tax credit to be stood up in the first place. But it's an interesting time, getting into Q2, the low point for demand, not necessarily on the crude front, but for gas. And where do we go from there? So I guess my synopsis on all my little diatribe here is whatever we see in terms of pricing behavior over the next 30 to 60 days, don't bet that that's the path for the rest of the year. Yeah. It's just what's happening right now.
Yeah. I think one of the interesting posts we had this week in the research archive, actually from yesterday, was just to look at what was going on in ERCOT's fuel mix this week relative to historical trends. And so wind and solar combined. So I guess ERCOT total renewable output hit a new record high of just shy of 40 gigawatts on Tuesday. And then yesterday, the ERCOT solar fleet followed that up with its own record of 26.3 gigawatts. So that was about 1.3 gigawatts higher than the previous record that ERCOT set earlier in March. So, we've talked about this before, but ERCOT is adding 7.1 gigawatts of new solar capacity this year, which relative to total U.S. solar capacity growth, that's 37% of what's getting added to all U.S. ISOs this year. So pretty interesting, but just another look at the ERCOT side this week for renewable output relative to load. We've had, 9 times that renewable output met over 75% of mid-afternoon power demand in Texas. So that'd be I guess, 7 records just in March. And for natural gas, what that's meant is that the share of gas in the overall fuel mix has fallen to an average about 24% over the last week as renewables have really kicked up. And in January and February, the average was 40%. So definitely see the Mother Nature related impacts to gas demand, especially when you're falling down to, at times just a small single digit percentage point of overall load being met by natural gas. Got some interesting charts on that too for interested people. I'll throw some in the slide deck, but I don't know if they support GIFs in PDFs. So I recommend going and looking at the research archive to see how that changes by year. You can see the concentration of negative power price hours in the spring months for ERCOT. So pretty cool.
And unfortunately for the power consumer, let's just say either of, anybody out there listening that may be nerdy enough to have gone to the Power to Choose website in a deregulated state to try to find the best power price they could possibly get. It can be pretty disappointing when you hear commentary like what you just shared. Well, if there's all this excess power, shouldn't power prices be really weak right now? And shouldn't I be able to lock in a 1 year, 2 year, 3 year deal with my provider of choice? And one would find themselves going, man, I thought I was doing a lot better than this in 2020 for sure. 2021, definitely. 2022, probably not. 23 and 24, better opportunities. So there's that pesky relationship. Like, you talked about the very right now of gas is crowded out, too much wind. Yeah. But the gas market is still relatively strong in the front. So too is the power market. Yeah. And I think in the end, so what's the conclusion? Power markets will tell you very clearly they don't believe that renewables are, in any way there to serve around the clock demand. They come and they go.
Yeah. Yeah. And you can really see that in some of these graphics, just the variability, even this week. So you have the record renewable output on Tuesday of this week. You have pretty strong solar, not crazy, but really strong wind. Wind is contributing most of that renewable generation. 2 days later, solar hits a all-time record of over 26 gigawatts, but then you have wind falling to about 6 gigawatts. So you have basically a 20 gigawatt swing over the course of 48 hours. And when, say, the sky is a little bit overcast, you don't have solar, what does that mean? There you go, natural gas. So yeah, it's definitely the volatility, I think, is the core takeaway, and what that means for the summer months too, when wind is not blowing as strong in Texas, at least. So interesting stuff to watch. With that, that's all I've got. I don't know if you have any other thoughts that you want to add.
I think I feel complete this week. Thanks for having me.
Yeah, it's a good one. A little bit faster. And yeah, we'll be back next Friday with some of the interesting stuff happening in the energy world. Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.